All right. Good morning, everybody. Good morning, all you magnificent melon heads. Happy Thursday, everybody. Today's March 28th, 2024. And the top story this morning is that cost estimates are finally starting to roll in for that collapse of the Francis Scott Key Bridge in Baltimore. And at least we got a couple of numbers this morning. Looks like 2,400 jobs directly affected at the port. That's longshoremen who will be out of work as the ships are unable to reach that port. And the initial dollar figures are somewhere around $3 billion. That is both to replace the bridge and the cost of the expected lawsuits, although those lawsuits just include the bridge and the wrongful death and the human cost. No word yet on how many secondary effects and how many lawsuits that might stem from other businesses that are being affected by the collapse of the bridge and if they might sue the carrier, not to mention the back and forth between the insurance companies. There are several insurance companies involved here. This thing is going to be a mess. It is going to play out over a course of several years, not months. And at the rate we build things in this country, well, I don't expect we're going to be seeing a new bridge anytime soon. But at the very least, we got some numbers starting to come in. And it looks like it's roll on, roll off cargo that's really going to be the most affected here. You know, there's a lot of container ships that go into that port. And Baltimore is not a huge port when it comes to container ships. You know, it's much smaller compared to like a New York or Los Angeles. And so that cargo could probably very easily be diverted to other ports. But namely vehicles, automotive, also large construction equipment, farm equipment, stuff that you would drive off the ship, if you will. Really, Baltimore is a major, major hub for those things. So that's where we're probably going to see the biggest dislocation in the market, as that is a major market that needs to find a new home. And I don't think there's any other ports that are very easily going to absorb all of that flow of cargo. So automotive and construction and ag equipment will be big ones. Other stories going on this morning. We have got Amazon is cutting their commercial real estate footprint by about $1.3 billion, although there were some odd statements by an Amazon public relations officer about, don't worry, this doesn't mean anything about work from home or remote work. That was kind of interesting. We've got China's banks are starting to feel the heat from their property collapse. Non-performing loans or soured loans, people not paying their bills are on the rise big time among China's biggest banks. Although strangely, they're all reporting rises in profitability. Apparently, people not paying their bills is good business for banks. Oh, that's right. We're talking about China, where the numbers are just completely made up on the spot. Don't worry. I know that happens here in the States also. And speaking of numbers made up on the spot here in the States, there's an article in Bloomberg this morning about private equity firms hiring private investigators to figure out what their shit is worth, because there's no price discovery in this market. This, as my friend Samantha LeDuc put it in a tweet yesterday, this is an unserious market. And she was talking about the pump and dump at Nilum Resources that rallied like 2,000% on the announcement that they were going to buy 24,000 Bitcoin or whatever. No worry about how we're going to pay for it. Everybody just bought the stock. And then, of course, the CEO of the company comes out and says it's a pump and dump, which at the very least, when the CEO of a company says my company's a pump and dump, at least that is still bearish. So we know there is a line somewhere. We just haven't found it yet. But this is an unserious market. There is no price discovery. Nobody knows what anything is worth. I talked yesterday about extend and pretend, about how people are just like pretending these assets on their balance sheet are really, worth what they paid for them, even though they clearly can't sell them for that. It's going on all over the market, especially in private equity, where they've got all these companies that they bought while interest rates were much lower. And they're all just saying, yeah, we bought it in 2021. It's still worth what we paid for it back then. Well, then why are you hiring a private investigator to figure out what it's worth if it's really worth what you were saying it was? So there's just no price discovery. This is an unserious market. And that just goes to show you that Wall Street, while you're being spoon-fed all of this, everything is great and the best economy ever, a number go up here, a number go up there. It's fake. It is not real. And even these firms that are telling you this data, they're telling you, oh, yeah, everything is great and our assets are worth so much money. Secretly, before they move them, sell them, buy them, borrow against them, use them as collateral, They're all hiring people to very quietly figure out what those things are actually worth. Gee, you think that might be an indicator that things aren't really as good as they're telling us? If only there were signs. Also going on this morning, we've got Home Depot is buying building material supplier SRS. This is Home Depot's biggest merger ever. And Home Depot is making a shift away from retail and more towards the pros and the building industry with this. It's a big bet on home builders. We'll see if it's going to pay off for them. But this is a challenging retail environment, to say the least. Home Depot has had a couple of really bad quarters in a row. I believe, 5 consecutive quarters of negative EPS growth for Home Depot. The same store sales not looking good for that company either. So they're making a shift into the wholesale market. They service home builders, construction firms, pool companies, roofers. So a little bit away from that retail store environment. We'll see if that one pays off for them. Walgreens is out this morning. Their numbers, their revenue, not quite as good as they were hoping for, basically citing a challenging retail environment. There's that phrase again. Also taking a big cost impairment or a big impairment charge on their purchase of a healthcare provider, as Walgreens had tried to pivot again away from retail, more into a whole healthcare company. Well, that is not working out so well for Walgreens. And with that, why don't we shrink my big melon of a head? And, let's see what is going on in this market this morning. We have got the S&P 500 is currently just barely positive, up 2.6 points. It just swung into the black while we were talking there. Currently, very little change in stocks this morning. The Dow is up about 42 points or 0.1% ahead of the opening bell. And the tech-heavy NASDAQ is just barely negative, down about 3 points, 0.02% lower. So a whole lot of nothing going on in stocks this morning. The dollar is a little bit higher, up 9 basis points. It was up about 50 basis points earlier in the day. It's currently moving lower. I don't know if some Fed official is out there jawboning while I'm talking right now or what, but we've got the dollar moving lower, still at 104.44 for the DXY. And looking over at interest rates, we have got largely unchanged, a little bit of move in rates this morning. The 30-year yield is the only one that's negative, 4.357 on the 30-year. That's down a fraction of 1 point. The 10-year is at 4.208. That is up 1 basis point this morning. The 2-year at 4.607. That's up almost 4 points this morning. And the 1 month is pretty much unchanged from yesterday morning, 5.375 on the 1 month Treasury. Looking over at commodities, gold, we've got a new all-time high in gold. Check this one out for June gold futures, $2,233. That's up $20 this morning or 0.93%. Gold is having one hell of a run here, guys. There's no clear reason other than I like gold. And, I don't think it's necessarily a bad time to buy gold, especially when you've got risk assets are priced at ridiculously high premiums. But we've got a slightly strengthening dollar. We've got interest rates that are probably not going to fall as soon as most people say they are. So, with a stronger dollar and maybe a slightly more hawkish Fed than people are hoping for, gold is kind of defying gravity here with this big move. If we see a major shift in a hawkish direction from the Federal Reserve, it won't be very good for gold here. But at least this morning, probably on the back of central banks buying up gold, in particular India and China. And China particularly, their central bank has been buying tons and tons of gold recently. You've got that arbitrage opportunity that has opened up as they're paying a higher price in Shanghai than they are in London. That's causing a flow of gold from west to east. And those big shorts from the big banks may be in trouble if this keeps up here. Gold making a new high this morning, but silver's still sitting this one out, $24.75 for May silver futures. That's up a couple of cents this morning, 0.09%. But silver has largely sat out this rally here. So let me know in the comments, which one is right here? Is silver right and gold is going to come back down to earth? Or is gold right and silver is about to moon? Because with gold at all-time highs, that would put silver in the mid-40s, which was its all-time highs. What was the all-time high in silver? Was it over 50? The Hunt brothers and the 2011 prices were all in that high 40s, low 50s range. If silver were to join gold and make a big rally, you're talking almost 100% upside from here. I like the shiny, to be honest with you. I buy metals not for price appreciation. I buy metals to store my wealth outside the financial system where these muckety mucks can't get to it. But hey, I wouldn't mind a little price appreciation while we're at it. So precious metals having a pretty good morning this morning. We've also got platinum and palladium are up here. Platinum is up about 0.5%. Palladium is up 2% and change here, back over 1,000 for June palladium futures. And West Texas Intermediate crude oil for May at 82.44. That's up $1.10 or 1.35%. Oil's looking pretty good this morning as well. Check out this spot gold price here, guys. We have definitely got a confirmed breakout. That one happened about a week ago or a few days ago. Here was the previous all-time highs, and we have broken well above that one now. Onward and upward we go. Where it stops, nobody knows. Bitcoin, on the other hand, also looking all right this morning, $70,700 for Bitcoin. That's up a little bit. We dipped down into the 60s briefly yesterday, popped right back above that. So it looks like that temporary pullback caused by the outflows in the Bitcoin ETFs is behind us. We haven't seen a new high yet, but it's still looking pretty good. And the inflows are back once again. That's 2 days in a row now we've seen a bump in inflows for Bitcoin. Currently $243 million in net inflows yesterday. Still got large outflows from the Grayscale ETF, almost 300 million, but the inflows into BlackRock, Fidelity, and the others. Notably, ARK Invest. Look at that big inflow into ARK Invest yesterday, $200 million of inflows into ARK's Bitcoin ETF. That's interesting. So the flow has reversed, and once again, institutional money is buying Bitcoin via ETFs. Let's see. Also going on, here we go this morning. This is the big one. Let's get him on the screen. We don't need to hear from him. Baltimore Union fears a loss of 2,400 jobs on bridge collapse. So this is the first impact on the labor market. It's the most direct one. Obviously, the ships can't get into it, so those guys going to get laid off almost right away. The Baltimore bridge collapse is poised to leave thousands without work, and there's no firm plan yet about how to help them. The local president of the International Longshoremen Association said, "I have 2,400 ILA members who are soon going to be without jobs," said Scott Cohen, president of the labor union's Baltimore local, said in an interview on Wednesday, "Getting them on the payroll and keeping their families fed, putting food on the table is my first and foremost thought on my mind." Baltimore's port is closed after the dolly slammed into the Francis Scott Key Bridge. So 2,400 jobs directly, immediately impacted. Those boats that are stuck in that port aren't going anywhere. There are no new ships getting in there. I don't know how long it's going to take to clear the debris to get that channel open. That's probably going to be the first priority now that it's no longer a rescue mission. But even that's probably going to take quite a long time to free that flow of traffic up. So that is the direct impact. No word about ancillary effects, about how many, indirect jobs might be lost, but 2,400 longshoremen, that is not an insignificant number. Now let's talk a little bit about the dollar impact here. Baltimore Bridge may trigger historic maritime loss, says Lloyd's of London. The collapse may become one of the biggest marine losses ever. Insurance payouts for Tuesday's collapse of the Francis Scott Key Bridge in Baltimore could be among the largest ever in marine insurance, according to Lloyd's of London Chief Executive Officer John Neal. This has the potential to be one of the largest marine losses in history, Neal said in an interview with Bloomberg on Thursday. It's a multi-billion-dollar loss. I think it has to be, but I think it's a little too early to say what you actually think it's going to cost. So a little bit of soft language here. The bridge collapsed Tuesday after being struck by the Singapore flag dolly, sending vehicles into the water, threatening chaos at one of the most important ports on the U.S. East Coast. Barclays analysts estimated that insurers face claims of as much as $3 billion. In a note on Wednesday, insurance claims for damage to the bridge alone could reach $1.2 billion, Barclays said in its note, predicting further potential liabilities of $350 million to $700 million for wrongful deaths and yet to be determined amounts for business interruptions while access to the city's port is blocked. So they are expecting lawsuits out the wazoo here. But who pays? That's another question. Something else for the lawyers to fight over. Determining who pays those claims will rest on whether the accident was caused by negligence or mechanical failure. Bloomberg analyst Charles Graham and Kevin Ryan wrote in a note on the day of the collapse, given the multiple parties involved, settlement of any claims is likely to be complex. There's quite a complex weave of insurers that are all involved with this, Neal said in an interview Thursday, adding that the firm assumes every year that this type of loss will occur, and that expectations for financial considerations are manageable. You got to love whenever they reassure everybody that expectations are manageable, right up until they aren't, and then they declare bankruptcy and don't pay anybody. But looks like $3 billion is the initial cost estimate, but don't expect any kind of closure on that. The only people who are really going to win here are the lawyers, because those billables are going to pile up as they fight back and forth over who's going to pay for what and who insured what. Now, onto the secondary industries. I've got this one in Farm Progress. This one was dated, this was actually Tuesday afternoon. Baltimore Port is an agriculture equipment hub, and the closure of the port in Maryland due to the bridge collapse could impact farm machinery exports and imports. So heads up, all you John Deere and Caterpillar owners, this one could affect you guys. The tragedy surrounding the collapse of the Francis Scott Key Bridge in Baltimore continues to unfold. Now they're getting into some specific industries here. For agriculture, the Port of Baltimore is the closest in proximity to the Midwest and is the largest U.S. port by volume for handling farm and construction machinery. So that easternmost side of the Corn Belt, really Baltimore is the port that services all of that. According to state data, the port handled a record 1.3 million tons of roll-on and roll-off farm and construction machinery in 2023. This includes tractors, combines, hay balers, and more. Now, the tonnage, it's a little hard to estimate based on tonnage because, right, when you're talking about excavators or combines, those things vary in size dramatically. So it's hard to say how many combines roll off and on every year. But this is the major port servicing that agriculture equipment. Also, autos is a big one. The Maryland State Government website states that the port's private and public terminals handled almost 850,000 autos and light trucks in 2023. That's the most of any port for the 13th straight year. So you can expect some impact for the automakers here, both importers and exporters. Bentley, Mazda, Mercedes, GM, all of this, whether domestic manufacturers exporting their cars or foreign manufacturers getting them into U.S. markets, the other ports are going to struggle to handle that additional capacity with Baltimore out of commission. So it's probably going to affect the auto industry, which is already having a hard time because of the affordability crisis and ill-advised bets on electric vehicles. Also going on this morning, this is a story that kind of had me chuckling and shaking my head at the same time in Bloomberg. Money managers hire investigators to find private asset values. Nobody knows what anything is worth. They're all blowing smoke. They're all basically lying on their balance sheets about what their assets are worth. And since there's no price discovery, well, nobody knows. And so how do you transact? How do you make deals? How do you lend against, borrow against something if you don't know what it's worth? Intelligence firm is being asked to investigate loan values. Short positions in business development companies are rising. Investor faith in private market asset values has plumbed such depths that some are taking matters into their own hands. Money managers are hiring investigators for on-the-ground information to help them learn more about the firms they're lending to or invested in, as well as value underlying collateral, according to Jason Wright, Senior Managing Director at financial crimes, risk, and regulatory advisory firm K2 Integrity, the corporate investigative firm co-founded by Jules and Jeremy Kroll. Guys, this is a really serious article here. They're using some very strong language here. Investor faith in private market asset values has plumbed to such depths that they're taking matters in their own hands. In other words, this stuff is not worth what they're claiming it's worth. It's too expensive. The price needs to go down. But again, all these NAV loans that they're doing, all these liquidity programs, all this extend and pretend nonsense is preventing price discovery, so much so that it's created a private price discovery industry where these investigator firms are being hired to go out and come up with a realistic number because we can't go with the propaganda numbers that they're releasing in their quarterly reports. What does that tell you about the accuracy of those quarterly reports? Private credit has boomed into one of Wall Street's fastest growing industries, more than tripling in size in the last decade to $1.7 trillion, as money managers gravitated to investments that promised high returns as well as a shield from mark-to-market losses. A shield from mark-to-market losses. Again, if you don't actually mark your thing to market, then you never actually booked a loss, so your firm is still worth all this money right up until the minute you go try to sell that asset or borrow against it. Then you need to go hire a private detective to tell you what it's actually worth. I'm sure this is going to end really well. Historically celebrated for providing stability, even when public securities were whipsawing, that attribute is increasingly being seen as a liability as investors fret that untroubled values may not be accurately reflecting true risks. There's a lot of discretion used by the managers of these portfolios, and the biggest questions we're facing now are about recoveries in these assets more broadly and how much can be recovered, Wright said in an interview. What's the true value of the debt here? In February, Bloomberg News reported that in some cases, the exact same loans were being marked wildly differently depending on whose portfolio they were in. The huge variations in pricing is also spooking regulators who are concerned that a lack of consensus may be masking more distress under the surface. All right, this is regulators, guys. This is the FDIC. This is the SEC. They are concerned that a lack of consensus or a lack of price discovery, a lack of mark to market, a lack of liquidity and transactions in the market, however you want to word it, nobody knows what it's worth. And so that could be masking more distress under the surface. They're lying to you when they tell you it's the best economy ever. The everything bubble isn't real. Or again, as Samantha LeDuc put it, this is an unserious market. So much so that they're hiring private investigators to tell them what their stuff is really worth. I'm sure this is going to end really well. Speaking of a lack of price discovery, across the pond in the Pacific to China, where they've got the same problem, it just sounds a little different. China's property crisis is rippling through its biggest banks. Again, the problem is nobody really knows what the stuff is worth because there's no price discovery. Sound familiar? Asset quality worsened in residential and corporate segments, and banks post scant profit growth as interest margins erode. China's protracted property downturn is eroding the balance sheets of the nation's largest state banks as their bad loans creep up. Bank of Communications reported on Wednesday that its property bad loan ratio jumped to 4.99% at the end of last year from 2.8% a year earlier. And what's the over-under that some Chinese executive or Communist Party official basically put a gun to somebody's head and say, don't you dare let that number hit 5%. Okay, 4.99 it is. Big difference there, just 499.99. While the balance of its overdue mortgages slipped, the special mention loans for that segment, a leading indicator of soured loans, jumped 23% to 9.88 billion yuan. That's about $1.4 billion. Bigger rival, Industrial and Commercial Bank of China, saw its bad loans from residential mortgages rise 9.6% to 27.8 billion yuan. That's according to a Wednesday filing. In the corporate loan segment, its property non-performing loan ratio was the highest among all sectors. Agriculture Bank of China reported a 4.7% increase in soured residential mortgage loans last year, while non-performing loan ratio for the property sector also topped other industries. All three banks, though, managed to report gains in profit even as interest margins narrowed. So isn't that amazing how all of these banks are seeing their non-performing loans are rising? People aren't paying their business. Asset quality is worsening. People aren't paying their bills. And yet the banks are saying, don't worry, we're making more money than ever. Our profits are still growing. Again, no price discovery. There's no accurate information. So there is no way of telling just how grotesquely insolvent China's biggest banks are. But it's a good bet they are horribly insolvent. And that if there's anything resembling a bank run in China, those banks would go under in the opening hours. There's just no way. Entire cities of buildings that were built for trillions of yuan in loans. Nobody lives there. Nobody rents them there. There's no cash flow. They're just sitting there. And that doesn't even begin to count all the buildings that they've already sold that haven't even been built yet. This is not going to end well for China's banks. It's only a matter of time. Also going on this morning, we've got Walgreens tops quarterly revenue estimates, but narrows their profit outlook due to a challenging economy. There's that challenging economy again. Their second quarter sales beat Wall Street estimates, but the pharmacy giant lowered the higher end of their 2024 adjusted guidance due to a challenging retail environment in the U.S. And that's why I'm mentioning that one again, guys. Besides none of the price discovery, besides all the BS that's going on in private equity firms and Chinese banks, while all this is happening, everybody, all the retailers, Home Depot, Lowe's, the clothing retailers, the apparel retailers, the auto industry, they're all posting big year-over-year declines. Now Walgreens among them, lowering their retail sales. The company posted a steep net loss for the quarter, as it also recorded a hefty goodwill impairment charge related to its primary care provider, Village MD. So there's Walgreens went out and bought this primary care provider. They overpaid for it, and now they are marking it to market. They're basically saying, yeah, we overpaid. We're going to call it a goodwill impairment charge. Basically means the brand isn't worth what we paid for it. So that's probably what all those private equity firms are going to have to do just as soon as their private investigators get back to them with a number. So challenging environment again, but it's the best economy ever because AI. I don't know. Pharmacy GPT. Hey, sure. No problem. Just, banks going under, bridges collapsing, ports that don't work. But AI fixes this. Home Depot to buy pro-focused SRS distribution for $18.25 billion in record deal. This is a pivot away from the retail consumer for Home Depot. They are doubling down on the big contractors. Home Depot shares slipped Thursday after the home improvement retailer announced it would buy SRS distribution for $18.25 billion, including debt, its biggest ever acquisition. SRS is owned by private equity firm Leonard Green and Partners and Berkshire Partners, and a specialty trade distribution company serving professional contractors, specifically roofers, landscapers, and pool specialists. SRS's ability to build leadership positions in each of its trade verticals while generating significant revenue growth is a testament to his strong vision, corporate speak here. SRS has built a robust and successful platform that will accelerate our growth with the residential professional customer. And that is the takeaway from this one. Home Depot is going after the contractors more. You can see it in Home Depot's advertising. They target the pros. They say more pros go with Home Depot. Whereas Lowe's, you can tell they're a little bit more DIY homeowner centric. So Home Depot is trying to branch out away from retailers here. The stock not doing quite so well this morning. Actually, it's up a little bit, about 0.25%, trading at $387, up about 0.29% this morning. Also, we've got Amazon plans to save $1.3 billion by cutting leases short and shrinking their office footprint. There's that commercial real estate bubble again. The tech giant has a 34% office vacancy rate. Yikes. Tech and e-commerce giant Amazon is hatching a plan to save $1.3 billion by significantly reducing its office space and ending leases early. The company has been one of the major U.S. firms in cost-cutting mode the past couple of years, and it wants to address a major chunk of unused corporate space that it's paying for. Business Insider first reported the latest plan, citing an anonymous source, of course. In response, Amazon spokesperson Brad Glassner sent a statement to Commercial Observer explaining the company is constantly reevaluating its real estate portfolio based on the firm's needs by looking at trends in how employees are using office space. Now, I found this comment from this corporate spokesperson was a little kind of all over the place here. In some cases, employees may move buildings to increase collaboration and drive better utilization of our workspaces, the statement read. In other cases, we may take on additional space where we're currently limited to make adjustments where we have excess capacity. To suggest that this is about anything else, such as expectations for working in the office, is at best a misunderstanding and at worst intentionally misleading. So this statement from Amazon's PR guy here, it's I don't really know what to make of this. They're cutting their office footprint by $1.3 billion, ending leases prematurely, negotiating, breaking lease agreements. And yet here they're saying, oh, no, it's all about driving more collaboration, and we might actually increase our footprint in some areas. Don't you dare go out there and suggest that we're going to let people work from home or anything about reducing our office. They seem very defensive here. I guess that's the takeaway. I was surprised to see how defensive Amazon was about drawing any kind of conclusions about their commercial real estate footprint. I think Amazon is probably struggling with a lot of people demanding work from home while trying to force them back into the office. And that is a tightrope that these companies need to walk here, because if they force everybody back into the office, they're going to lose their top talent who can name their price and go to another firm that doesn't force people back into the office. At the same time, you have non-performers, mediocre performers who you need to get them back in the office in order to get any productivity out of them. So Amazon is trying to have their cake and eat it too here, it looks like. But I was very surprised to see how defensive Amazon would be about reducing their office footprint. Maybe there's something else going on there. I don't know. It's a little early in the morning for me, though, guys. I just want to say thank you very much to Cole Marsh, who says, sue me. No, I sue you. I think we're talking about the insurers here. Everybody's suing everybody. It's a great time to be an attorney. Let's just put it that way, because no matter what happens in court, the attorneys win every time. Thank you very much, Cole Marsh. Appreciate that, sir. And thank you for being a channel member. And what's up, Nashville Pasta Man says, what's the paper allocation versus physical in number of ounces? Foreign banks are buying gold. They're buying physical gold. People are investing in digital code. Who was it? Was it HSBC? Pasta Man just came out yesterday. They've got a new gold token, creating a new way to create a paper claim or a digital claim on gold. Now they're not even using paper. They're just making it digital. That is part of the problem, I think, and that is part of what could end up creating some big, eventually, this is not an any day thing, but the number of paper claims on physical precious metals, for every ounce of metal that's out there, there's 2, maybe even 3 or 4. I've heard estimates as high as 100 paper claims against that physical ounce. And right now, you still have a market that is somewhat functional, even though it's heavily manipulated. If at any point you ever get the equivalent of a bank run on paper claims on gold, then the physical price of the metal would skyrocket, while the paper price, just nobody would know how to value it, because everybody would be going belly up. Nobody would be willing to part with their physical for any number, because there wouldn't be any price discovery. We almost got that in January of 2021. Almost. It was only through a lot of dirtbaggery that the banks and the ETFs were able to suppress that. But that underlying problem is still there. There's still a lot of unallocated gold schemes, gold tokens, gold-backed cryptos out there. They're all the same. They're all different variations of the same thing. A guy who's got 1 ounce of metal or 10 ounces of metal, if you're holding this, and he's sold 100 ounces worth of metal based on his 10 ounces that he's got in his possession. And what happens if they all want it at the same time? Well, right now you've got Western central banks, or Western banks, are creating digital claims on metal, while Eastern central banks are buying up the physical at breakneck pace. And so it's driving prices higher. Thank you very much, Nashville Pasta Man. Appreciate the super chat, the support of the channel, sir. Thank you. JJ Watt says, hiring surge in armed IRS agents to pursue delinquent credit card users and loan defaulters. Tinfoil hat. All right, I'll go ahead. I'll put the tinfoil hat on. Do I think the IRS needs a SWAT team? No, I do not. A hiring surge in armed IRS agents. I haven't seen that data point, so I don't know. There's a lot of stories out there about the tens of thousands of IRS agents. Look, anytime they expand the funding for an institution like the IRS and they say they're going after the wealthy, they're going after the big businesses. No, they're not. It's too expensive to go after them. The cost benefit, the risk return of targeting an Amazon for tax evasion, it's going to cost the government so much money. There's going to be so much legal back and forth. They're going to spend more resources targeting Amazon than they're going to collect in the form of those taxes that they're not paying. And so every time the government officials in these muckety-mucks tell you we're going to expand the IRS and hire new agents so that we can target those tax cheats at the big businesses, you know who they're really going to go after? They're going to go after small businesses who don't have armies of lawyers and don't have big accounting firms that they can just, through a war of attrition, convince the government to go look elsewhere. They're going to pick on the little guys. They're going to pick on small taxpayers, middle income earners. Every time, that's how it works. And that's why they're hiring thousands of IRS agents. They're telling you they're going after the big dogs, but the big dogs bite back. They're going after the little dogs every freaking time. And watch out, you crypto guys, with all these KYC laws and the on-chain metrics, all you guys who are hiding crypto profits, they will definitely be looking for you guys as well. So just be smart, folks. I'm no fan of the tax man here, but I don't want to see people hauled away in bracelets. Thank you very much, JJ Watt. Appreciate the super chat, the support of the channel, sir. And everybody, I hope you have a wonderful Thursday. Thank you guys for having your coffee with the Melon Heads this morning. Thank you to all my Patreon supporters. Looking forward to talking to you guys and my magnanimous Melon Heads on our Zoom get-together at 6 p.m. Eastern time tonight. Links down below to all that good stuff should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Till next time, live small and dream big.